Warren Buffett, known as the Oracle of Omaha, is one of the richest people in the world, with a net worth of over $100 billion. But here's the shocking part: most of his wealth came from just 15 core investments. Yes, 15? If you had invested just $1,000 in Buffett's top picks in 1965, that $1,000 would be worth around $23 million today. That's the power of value investing. In this video, we're diving deep into the best investing advice ever shared by Warren Buffett. We'll break down his top strategies that have helped him create unimaginable wealth. You'll learn how to pick the right stocks, avoid common investing mistakes, and build a portfolio that stands the test of time. But here's the kicker: Buffett's strategy isn't about chasing the latest trend or worrying about daily market moves. It's about making smart, patient choices that lead to long-term success. Stick around, because by the end, you'll know exactly how to think and invest like Warren Buffett. Chapter 1. The Oracle's Secret Sauce. Warren Buffett is often called the Oracle of Omaha for a reason. His investment strategies have turned billions into trillions. But the secret sauce behind his success isn't magic, it's a clear set of principles. The first ingredient is patience. Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." If you want to invest like him, it's all about waiting for the right opportunities. Buffett doesn't rush into every trend that catches attention. Instead, he sticks to companies he understands deeply. This is called his circle of competence, and it's crucial. By investing only in industries and businesses that he knows well, Buffett minimizes risk and makes smarter decisions. The result? A consistent track record of growth that has made his company, Berkshire Hathaway, one of the most successful firms in history. Another key strategy is his focus on long-term value. Buffett doesn't just look for a quick win, he looks for businesses that will continue to grow for years. In his view, good companies can endure market volatility, and that's where the true wealth is built. An interesting stat shows that Buffett's investments have outperformed the S&P 500 by an average of 2% per year over the past 50 years. That may sound small, but over decades, it adds up to massive growth. Buffett also emphasizes the importance of business fundamentals over short-term market fluctuations. He often says, "Price is what you pay. Value is what you get." This means that an investor should focus on the underlying health of a company, not just its stock price. Over the years, this approach has led Buffett to buy stocks like Coca-Cola, American Express, and Wells Fargo when they were undervalued. Chapter 2. Buy like Buffett, not like the crowd. If there's one thing that sets Buffett apart from other investors, it's his ability to think independently. While many investors follow the herd, Buffett steers clear of popular trends. He's not afraid to go against the grain, and that's one of the main reasons he's been so successful. His rule is simple: be fearful when others are greedy, and greedy when others are fearful. Buffett saw the 2008 financial crisis as a golden opportunity. While others were panicking and selling, he was buying stocks at rock-bottom prices. The financial crisis showed the importance of not letting fear drive your decisions. When the market crashed, Buffett was able to scoop up stakes in companies like Goldman Sachs and General Electric, which went on to bounce back. Interestingly, studies show that Buffett's ability to buy during crises has led to massive returns. In fact, buying stocks in the wake of recessions and market crashes often yields higher long-term returns than buying during bull markets. This is one reason Buffett's advice is so valuable. You don't have to predict the market. You just need to know when it's the right time to buy. Many investors get caught up in the hype of new tech stocks or hot trends, but Buffett avoids these distractions. He sticks to what he knows and focuses on solid companies with predictable earnings. For instance, he's passed on tech giants like Google and Amazon because he wasn't confident in their future growth. He simply couldn't understand the business models fully. Chapter 3. The Margin of Safety. The ultimate safety net. One of the most important concepts in Buffett's investing philosophy is the margin of safety. This strategy involves buying assets at a price significantly lower than their intrinsic value, providing a cushion if things go wrong. It's like buying a house worth $500,000 but paying only $300,000 for it. That extra $200,000 is your margin of safety. Buffett doesn't believe in gambling with his investments. He prefers a comfortable margin that can absorb inevitable market shocks. Risk comes from not knowing what you're doing, he once said, and that sums up his approach perfectly. By ensuring a margin of safety, Buffett minimizes risk while maximizing potential rewards. This principle also applies to stocks. If a stock is trading for less than its true worth, it provides a cushion if the market turns against you. According to a study by Morningstar, companies with strong margins of safety tend to outperform the market in the long run. Buffett's success is tied to his ability to identify undervalued companies with a built-in margin of safety, making them far less risky. For example, when Buffett bought Coca-Cola in 1988, he didn't just see a popular brand. He saw a company with predictable earnings, an established market, and a stock price below its intrinsic value. This made Coca-Cola a perfect fit for Buffett's margin of safety strategy. Don't forget to subscribe to the channel for more insights on how to build wealth like Warren Buffett. Hit that bell icon so you don't miss out on the next strategies that have made the Oracle of Omaha one of the richest people in the world. Chapter 4. Moats, Monsters, and Market Leaders. Buffett is a big fan of companies with a moat, a term he uses to describe a business with a sustainable competitive advantage. Think of a moat around a castle. It keeps competitors out and protects the business. The wider the moat, the more likely the company is to continue growing. Buffett looks for businesses that are monopolies, or at least have a large share of their market. These companies can fend off competition and maintain strong profits year after year. Take the example of McDonald's. The fast food giant has a wide moat thanks to its brand recognition, global presence, and unbeatable supply chain. Moats come in many forms: brand power, network effects, cost advantages, or regulatory barriers. Take Apple, for instance. Its moat lies in its brand loyalty and ecosystem of products, from iPhones to Macs. Once a customer enters the Apple ecosystem, they're likely to stay, making Apple's business model incredibly sticky. In addition to moats, Buffett also looks for market leaders. These are companies that dominate their respective industries, just like how Coca-Cola leads the beverage market or how Visa is a global leader in payment processing. By investing in these market leaders, Buffett ensures that his investments are backed by stable, long-term growth potential. Chapter 5. Patience. The Buffett way to wealth. Patience is perhaps Buffett's most famous trait. He is the epitome of the long-term investor, and it's one of the reasons why his wealth has grown so substantially. Our favorite holding period is forever, he says, and that's not just a catchy phrase, it's a guiding principle. Buffett doesn't believe in flipping stocks or chasing short-term gains. Instead, he buys companies with the intention of holding them forever. This strategy allows him to benefit from the compounding effect, where the value of his investments grows exponentially over time. Studies show that the longer you hold an investment, the greater your chances of success. In fact, according to a study by the CFA Institute, long-term investing outperforms short-term trading by a wide margin. Buffett's portfolio, which includes long-term holdings in companies like American Express and Coca-Cola, is a testament to the power of patience. Patience also means not panicking when the market drops. Buffett has seen countless market crashes during his career, but he remains calm and sticks to his strategy. He knows that short-term volatility is just noise and that long-term trends are what matter most. Chapter 6. The $1 million decision. If you had $1 million to invest like Warren Buffett, what would you do? Buffett himself often talks about how he would invest that money. His answer: put it in a low-cost index fund. While this may sound simple, it reflects the heart of Buffett's investing philosophy. Buffett believes that most individual investors are better off investing in index funds rather than picking individual stocks. His reasoning? Index funds provide broad diversification, low costs, and steady growth over time. Buffett's bet against hedge funds is legendary. He famously wagered $1 million that a simple S&P 500 index fund would outperform a group of hedge funds over 10 years. He won the bet. The beauty of Buffett's strategy is that it doesn't require a deep knowledge of individual stocks. If you're just starting out, following Buffett's advice on index funds can provide you with solid returns over the long term. It's an easy, low-maintenance way to build wealth. But if you have the time and knowledge to pick individual stocks, Buffett's focus on value and long-term growth still applies. His approach is clear. Buy undervalued companies with strong fundamentals and hold them for the long haul. It's not about picking the next hot stock, it's about choosing the right companies and waiting for them to grow. Thanks for watching. Be sure to subscribe and hit the bell so you don't miss any more investing secrets from Warren Buffett.